Right now, this very moment, trillions of dollars are being created, moved, or erased without a single vote, headline, or public announcement. These decisions shift markets, change the cost of your groceries, your rent, your salary, and yet most people don't even know the meetings happened. The truth is unsettling. The real power in the global economy isn't held by presidents or billionaires. It's held by central banks, institutions that operate quietly, behind closed doors, using tools 99% of people can't explain. And here's the twist. Most money that shapes your life doesn't physically exist. It isn't printed. It's generated instantly by keystrokes and policies hidden from everyday view. Today, we're uncovering how central banks learned to move unimaginable amounts of money without the public ever realizing it happened. To understand how central banks became the hidden engineers of the global economy, we go back to a time when money was simple metal, coins, grain, and goods. But kingdoms had a problem. Wars were expensive, gold ran out fast, and rulers needed new sources of funding. That's when merchant banks emerged, families across Europe who understood numbers better than kings. They realized something revolutionary. Money didn't need to exist physically, it only needed to be promised. This idea reshaped the world. In 1694, William Paterson founded the Bank of England and revealed the secret that defined the next 300 years. The bank hath benefit of all interest which it creates out of nothing. From that moment, power shifted. Money was no longer a physical object, became a claim, a promise, a ledger entry. This model spread eventually. It crossed the ocean and quietly became the backbone of the United States financial system. The US Federal Reserve was created in 1913 after decades of financial crises. The final planning meeting took place in secrecy on Jekyll Island, a remote, heavily guarded location far from public eyes. Once the Fed was born, the game changed. Instead of gold or paper, the supply of money became a policy decision controlled by a central authority. The public no longer decided how much money existed. The Federal Reserve did. This wasn't illegal, it wasn't hidden, but it wasn't explained either, and that silence made it invisible. The true rise of central bank power came through three major steps. As long as dollars were tied to gold, central banks were limited. But in 1971, President Nixon ended the gold standard. Money became fully fiat, created by decree, backed by nothing but trust. Now, supply could grow without limit. Step 2. Digital money takes over, banks digitized, and physical cash became rare. Most money became numbers, entries in databases. Easy to adjust, easy to create, easy to delete. Central banks don't move money physically. They use invisible mechanisms with simple names: open market operations, repo markets, quantitative easing, interest rate signaling, liquidity injections. With these, they can shift trillions inside the financial system without a single press conference. During the 2008 crisis, The Fed quietly issued over $16 trillion in emergency loans worldwide. Information the public didn't see for years. The 2008 crash exposed a truth the world wasn't ready for. The financial system collapses unless central banks rescue it. Banks ran out of money, credit froze, markets fell, and within days, central banks created trillions digitally to stop the collapse. This sent a message across the global system. Markets believed central banks would always bail them out. Governments realized spending had no strict limit. Banks took bigger risks, knowing they'd be saved. People, meanwhile, faced the aftermath: stagnant wages, rising costs, widening inequality. After 2008, money creation became routine. Then 2020 arrived. During the global lockdowns, central banks created levels of money that once seemed impossible. The Federal Reserve, $3 trillion, European Central Bank, $1.8 trillion, Bank of Japan, $500 billion. Financial markets surged, asset prices exploded, inflation returned with force. And yet, most people never understood the root cause: silent, rapid money creation. Section 6: Failed Fixes. Why the system can't stop once central banks inject money. Removing it becomes almost impossible. If they reduce their balance sheets, markets fall. If markets fall, lending freezes. If lending freezes, businesses collapse. If businesses collapse, the economy falls apart. So central banks remain trapped in a cycle of intervention. They can withdraw slowly but never fully. They can tighten policy but only until something cracks. They control money, but they're also controlled by the system they built. Section 7: Modern Parallels. The pattern that won't end. Zooming out. The cycle repeats across history. Money detaches from real value. Financial systems grow unstable. Central banks intervene. The intervention creates bigger bubbles. Those bubbles burst. The next crisis demands even more intervention. Global debt is now above $313 trillion. More than 90% of all US dollars were created recently. Central banks own more assets than at any other time in history. The system is stable until belief weakens. Conclusion: 3 takeaways. A warning and CTA: the economy only functions because central banks constantly intervene.